Hey everybody, we're live with the Holy Macro Show. It is Friday, and there's so much to talk about. Kevin's got to go in a sec, but we're going to do a quick hit with Kevin real fast. Just kind of understanding your macro view. I saw you on the show the other day on All Star Charts, just kind of going over some random stuff, and something that
Yeah.
interesting was materials. Some of these sectors that were very unloved last year, you're kind of looking at right now. So what are you seeing in those sectors, Kevin? And generally take us through your mindset. How do you find these type of trades?
Yeah, so for materials, it was more of a technical setup. If you kind of go back and look at the weekly chart, which is what I actually do, I do that all the time. I look at weekly charts for any setup first, kind of give me a little bit of confidence that something could work or maybe it doesn't work. And so materials, if you kind of look back at it, obviously had a nice little pullback here, but it was hitting the 200-week moving average. On December, it hit it, in January, it hit, and that's actually a really key moving average. And actually, if you kind of go back on October 23rd, it did the same thing. October 23rd, 2023. We saw a bounce to the upside here. So that's kind of what the technical setup was for. And then also we had obviously the wildfires kind of taking place. You have the tariff policy issues as well, which could be a headwind for some material companies in a sense, but also could also push up margins, right? Prices kind of they increase prices higher in anticipation of potential tariffs, and that could be a tailwind for them. And then if they raise prices and tariffs are not as aggressive, then what happens, right? Their margins expand. So there's kind of that fundamental story there. If you're looking at the XLB, I would say like the 91.50 area for materials probably would be that area of resistance that aligns with the 20-week moving average. But it's been a nice little pop to the upside here, pretty much for the start of the year. Same thing when you're looking at industrials. Industrials had a nice little pullback, came back to the 100-week moving average. Then we saw a nice little bounce to the upside here, tested the 20-week moving average, and then bounced higher. And so industrials are kind of a little bit more unique, right? Everybody's kind of talking about GE. GE has had a phenomenal year, to say the least. But from the industrial side of the equation, if you don't see aggressive tariff policies in certain markets like China, they're going to be a direct beneficiary of that. And then also, if the tariff policy is not as aggressive, we may see the dollar actually move to the downside. A lower dollar should theoretically increase export demand, which would be a direct benefit. Companies like GE, companies like Caterpillar, things of that nature would be a direct beneficiary of that. And then lastly, the data center AI build out, stories that you're kind of hearing. $500 billion here, you're seeing 600 billion potentially from the Saudis. I mean, you're talking about a lot of money. Now, question is all that money actually going to be realized? At the end of the day, market really doesn't care. They care about the headline right now. Who's going to follow up 2 years, 3 years from now? So if you're going to build out that infrastructure, what are you going to need? You're going to need industrials. You're going to need materials for that. So I think there's a little bit of a secular trend and kind of a narrative that's building for those two industries. But I also believe too, kind of when you're looking at the performance of the S&P 500, we've obviously had this breakout to the upside here. The technicals kind of aligned. The MACD crosses aligned up. You saw that follow through here. And so you kind of look at each and every sector and say, okay, where can we continue to see a run to the upside? And actually, it's Mag 7 right now. So there has been this bull flag channel that occurred for the S&P 500. We all been looking at it, the mini S&P futures. We've all been looking at it. Mag 7 had the same thing, but it actually just officially bounced and broke above that channel line 2 days ago, right? And so if you're gonna, so meaning that if they're not really at, if you take the mags ETF, they're not at all-time highs yet when you're looking at the conglomerate here, so they still have some room to run to the upside, and I think that's where you're going to get that follow-through performance. From the economic data standpoint, look, we had some PMI data that came out here today. S&P Global PMI, they're not like as impactful as ISM, but a key area here is manufacturing PMI actually was in expansion territory. That's actually a very key area to kind of focus on there. Services PMI came in a little bit light. Existing home sales came in better than expected. That trend may continue just based on some of the other economic data we're seeing in the housing market, especially on the existing home front. Even though rates are a little bit higher, you are seeing maybe pricing pressures to the downside for homes that makes it a little bit more attractive for those to buy. And then we had the consumer sentiment data that came in today from the University of Michigan. Sentiment actually was lower, revised lower. Current conditions revised lower. Inflation expectations for the 1 year met the street's expectation of 3.3%. 5-year expectations slightly lower here. So next week, we're going to get a whole boatload of data. We have the Fed meeting next week. We got GDP numbers coming out next week. We have what? We have what durable good orders next week. We have PCE on Friday. We had a lot. And so I think the void that we had in economic data this week was actually a really good environment when you're looking at it just because of the inauguration. And, Trump's going to come out swinging when it comes to economic policy. So that kind of gave us that thrust to the upside. Next week, let's see how the market actually balances out economic data and the commentary that we're hearing from the Trump administration. I still say that, if I go to seasonality does matter for me. And in the last 15 years, we've seen a pop in volatility the last 2 weeks of January, pretty much all of February, and then it subsides at the first week of March. I still believe that's on the horizon. So volatility right now, if you look at the VIX, is actually very low. Premiums are very cheap for hedges to the downside. And even if you want to have upside exposure, but may not want to put a full amount of capital or a large amount of capital at work in order to do so, you could go long call options, even longer dated call options. If you look at the risk curve, it's actually relatively cheap. So you can actually use those calls longer term duration to kind of get upside exposure without having to put a fair amount of capital in if you are concerned that we do see a vol spike. So that's kind of what I've been keeping on the radar. We had BOJ 25 basis points last night. I think the biggest risk there was their commentary. Look, they hit the mark. They didn't mess this one up like they did in July and August of last year, where the commentary was god awful compared to the action that they took. So I would expect yen to actually gain a little bit of strength, dollar to get a little bit either stable or maybe seeing a little bit of weakness. But that also comes with yields actually kind of rebounding to the upside. If you're looking at a 20-day 4-hour chart, there's an inverse head and shoulders that's playing out with yields right now, that if we break out that neckline to the upside, maybe yields actually move higher. And I think that also aligns with the Fed commentary that we're going to see next week. I don't think that you're going to hear Powell as optimistic as Waller. And I think the market's trading on Waller's comments or anticipating Waller's comments and pricing that in rather than what Powell is going to say. And I think Powell might be a little bit more measured in his optimism, as well as the trajectory of rate cuts moving forward, which could actually push yields up in the near term here. So that's what I got. What do you guys think?
No, I love that because there's so much to unpack there. And the one thing I wanted to also mention, so I've been, if you guys check the yesterday's report, so I've been working on coding and back testing the regime model for years, basically. Finally, I've got it to the point where it's actually automated. So I finally posted that recently. And to your point, it's actually spitting out that we're in a reflationary environment as growth continued to slow down over and over again. We're kind of looking at a situation of going into a more of a stagflationary environment, but now in the last 6 weeks, we've kind of seen that reflation theme kind of pick back up again. Something you and I talked about over a year ago now continues to kind of be a trend that's emerging. It hasn't really completely taken hold, but it continues to emerge over and over again. So I find that very fascinating that you mentioned all that. Gishap, do you have anything to add to that?
So I found one point that Kevin said very interesting, which is talking about the AI capex, that you can just throw around numbers like 500 billion, 600 billion, and it doesn't matter if they don't materialize because who's going to fact check it. So if you go back to the dot-com bubble era, there were actually clear rules in place where the SEC would prosecute software companies for announcing vaporware. Vaporware meaning you announce that you have this crazy piece of software that is going to be, changing the world or something like that, and then turns out to be nothing. So a company which used to put out announcements like that used to get prosecuted. So it was a criminal act. And now we have come to the point where you can just throw around numbers with Elon Musk saying that Sam Altman does not have that money. It's out in the open. And you can still make such statements and get away with it because no one is looking. And I think that's something that speaks to the level of incompetence at the SEC. There is no one looking, so you can just commit whatever kind of financial fraud that you want, securities fraud that you want, and the market is just all algos, and they just, number go up, and that's all the market is. And I think that's something that just rubs me the wrong way, because that's not how security market should work, because it's end of the day it's people's money, and when the vaporware doesn't materialize, it's all these pension funds, institutions, all of them getting hurt. And I don't know why this is being allowed. So But the point that you made is so true because that's all that really matters. You just put up any headline you want, stock goes up. And in fact, there were so many of these companies which put out such statements with regard to Bitcoin. So there was this one company called Nilam Resources or something. They said they had like $1 million or $2 million worth of, or billion, I think, and the market cap was like 1 million, and the stock shot up like 10x in a day and then crashed. It's like outright pump and down, and nothing happened. No one got prosecuted. Absolutely nothing happened, which just tells all these criminals that they can just play fast and loose with the rules, which is a really bad image for the capital markets. The one thing that happened post .com was Arthur Anderson was killed, and it was killed for a reason because, and of course, Henry Blodgett and all those so-called Wall Street analysts, even they had their careers ruined, and that's because the aftermath of a bubble like this ruins a lot of lives. And I think that's something everyone is missing because everyone just thinks that as long as we participate in this bubble, as long as everyone is committing fraud and we are all profiting from it, it's fine. But someday someone's going to get hurt, and then all of this will come back and bite the people who make such statements. So I think we have to be very cautious about just trading the news like this
Good,
because
Kasha.
there is, yeah.
Yeah, Kasha, let me push back on that. I'm with you. Does it make it a little bit different? Because the environment, you got to trade the environment that you have. And I trust me, I've hated trading this environment for the last 2 years, honestly, right? Like it's a cool trend market, but like in my opinion, there are certain writings on the wall that no one's taking seriously that they probably should. And maybe one day that does actually happen and you do see that, some cracks in this market. Hasn't happened yet. But my question to you, does it make a difference when the president of the United States is sitting right next to you? Like, he's not going to also take that L. Let's say if it's not correct. Because I think also you got to think about it too. $500 billion is a boatload of money. You don't come like this situation, right? They're making $100 billion investment, and then like 2 weeks later, in the same conference, make it 250, and then this announcement where he's like, yeah, you asked me for 250, I did 500. Like, there's people that have money, not $500 billion worth of money that they can just put in their back pocket, pull out of their back pocket, right? Knowing though that the president of the United States is sitting right next to you, kind of also gives the signal that it is acceptable for now. I'm not saying it's the right thing. I think you're saying it's not the right thing. I think I'm right there with you, but it seems like there may not be an accountability measure, right? Time goes on, so that people forget, and I kind of go back and say, I bring up this grain deal a lot, and everybody that I talk about, a lot of the people that I talk to on a daily basis or I speak to, they're trying to learn about equities, right? Even though I love commodities 8,000 times more than trading equities, hands down. And I always bring up the grain deal, and sometimes it doesn't land with people because they just don't understand what happened. You guys remember the grain deal? That was the same thing. I mean, you were asking for a major commitment from China to import, corn and beans from the United States, and those commitments weren't even close to being fulfilled for that agreement, right? You go back though and say, lives were ruined for sure. Acreage planted dropped for sure. Small farmers that didn't have hundreds of thousands of acres, they may have had a small amount of acreage. They lost their farms because of this shakeup in this trade deal. But at the end of the day, was there any accountability? No. 3 years, 4 years later. So it seems like you can kick the can down the road, and then by that time, you're like, hey, what happened?
So I think it's different for commodities, right? Because there are no insider trading laws, and it's a global free market. Whereas if you look at US capital markets, there is technically a regulator who is supposed to make sure. So you remember when Elon Musk tweeted funding secure, and there was a lawsuit on that. And when Elon Musk tried to back out of buying Twitter, there was a lawsuit on that. So you had these situations where the system worked, and that is what gave people the confidence to invest confidently in US stocks. Now, you're absolutely right. When you have a president launching meme coins 2 3 days before inauguration, and SoftBank just comes out and says all these ridiculous numbers and no one corrects them, that kind of does tell you that yes, there'll probably be no accountability. But if you look at what that means for the long term, it means stay the hell away from tech, because when this implodes, it's going to be so rapid that you're just not going to have time to get out. And when there are opportunities in commodities, opportunities in places where there is no such fraud, why bother chasing the same thing that everyone is chasing on the back of news that you know for sure to be wrong?
Let me get into this a little bit, just because this is and Kashap and I have these debates all the time on this, because it's so it's, we could say this, the whole bubble, once again, like, if we're talking about this and it's been a bubble for a long time, we could say this same thing 10 years ago, 5 years ago, 2 years ago, like, it's the same conversation, because yes, who knows? Like, I don't, and I'm not a person who goes and digs as deep as you do. So you know a lot more than me on the individual names. Me just looking at the sectors, like, it's one of those things where I completely agree with you. The problem is, how do we trade it then? Do you just say, hey, for the last 2 years, you should have just stayed out of tech because there was a possibility of this happening? And we could say that, sure, and some people could do that, but at the same time, you've made a lot of money in tech, and really, I think it all comes into the, how are you going to trade it? If you're a person, you're putting your retirement away, would I say, and this is a thing that we should talk about, there's different time frames. So, a day trader, does this matter to you at all? No. For a swing trader, you're in the market for a week to a couple months, does it matter to you? Not really. Position trader like myself, a little bit more long term, 6 months to a year, stop losses and futures where it's very liquid to get in and out, not really. But if we're talking about people investing in their retirement accounts, this might be something that's very interesting, because maybe, and this is a good question I'll pass to you guys. If you today had money to put into a retirement account, this was a fixed account, you can't get it in or out, you're basically buying the S&P 500, would you wait on it, or would you do it today? And this is a question I get all the time from people.
You gotta buy. You gotta buy. Hey, long term, your long term time frame, you have to buy.
30 years, let's say 30
Yeah,
years.
you have to buy. Now, if you wanted to get a little bit more tactical with it, and you had the concerns that Kashap has, because I think that you are both right. I'm of the mind that, hey, you got to trade the trend until the trend fades, and unfortunately, you got to get your hands dirty. I think that's actually the best way to put it.
That's actually
sometimes
perfect.
you have to you got to get your hands dirty. I feel icky buying something that's trading at a 50, 60 multiple when it shouldn't be there. Yeah. It's very tough, but it's kind of like, you got to be the first one to get in and the first one to get out, and risk management's key. But if you had to have,
we're talking about people, no risk management, just nothing. Like, that's a great, perfect point for people like us, but
I mean, I still think that you look, and there's, everybody's going to be different, right? So let's say that you were concerned about the next, year or 2 years, and the next 6 months or what have you, right? And you still had a retirement account, because you still rebalance retirement accounts. You don't buy something and hold it for 30 years, and no one should be doing that, honestly.
Yeah.
If you were a little bit concerned, I would look at total return funds. They don't sound sexy, and they're not, but you get the income stream from the dividends that are held under there, or if you have any type of covered call strategy that's in there, you're not going to get as much of the beta, but you do get some form of upside exposure. And if we do see a rapid decline in tech or communication services, and that leads to some type of economic pullback, you go back to the defensives in the market, right? If you needed to have exposure. And so if you didn't want to be that risk averse, you look at total return funds, and then you can also just diversify and get into, Qs and things of that nature. The reason why it's hard is because this is a secular trend. And secular trend, what does that mean? That means that there's something that's actually transformational in an industry that we have never seen before. And so none of us actually has the full view of what's going to become this AI theme, right? How far can this go? Is this the internet? Is it the internet just kind of starting off, and then this wide open array of opportunities out there, or is this kind of the start of mobile pay functionality where Venmo kind of took it at the start, PayPal had it at the start, but now everybody has that functionality, right? Where still there's no real premium in there, but it's still it was an innovative tool to be able to say, hey, I can just cash app you something, or I can Venmo you something. Revolutionary when it comes to transacting money within the economy. But now it's not so much, it's more of a staple. You need to have this as a financial institution rather than something that's truly innovative. So I think that's where we're at. I would say Bitcoin the same way. Look, Bitcoin's had a really nice run, but remember the height of Bitcoin itself still didn't have application, and it still, in my opinion, doesn't have a utility, an overall utility. I think the utility is being built out by potentially government intervention, which we won't argue that today. But at the end of the day, Bitcoin was like, hey, this is actually revolutionary. And let me say this, guys, scratch what I just said. Blockchain technology. Okay, that's a better way. And everybody needed to have blockchain technology in their organizations. UPS talked about how they were going to build out their whole logistics chain on the blockchain itself, right? What happened with that? JP Morgan, everything that they're going to do on the back end as far as tracking transactions is going to be blockchain related. What happened with that? So that's the theme of blockchain. I didn't mean to say Bitcoin, but blockchain is kind of that boom bust cycle where it's like, yeah, very innovative and something that can be applied. But how do you actually throw a multiple on that use case of that technology? You really can't. And so that's how I think everything is right now here. And unfortunately, I do have to jet, but I'll leave you guys on this. It's unfortunate. It's unfortunate that we have really good things happening and really innovative things, and then you have bad actors, and you will always have bad actors no matter what market you're in. No matter what market you're in, it could be hard assets, it could be soft, it could be whatever. IP, you're gonna have bad actors there. But if you kind of go back and you trust the larger companies, if you trust them that they're going to do the right things, over time, it seems like they have been able to pay off. You've got the one-offs, the Enrons of the world that'll scam you out, the Nikolas of the world, that fake driving functionality and all this stuff. You're going to have those one-offs. But I think if you kind of look at the broad-based trend, you got to go with the trend until it breaks. And we might be, I'm not making a call here. It seems like the actions that are taking place, I'm going to set Kashop off real quick here. The actions that you are seeing recently, no, I'm not, symbolizes that we might be near an event that Kashop is talking about. Meme coin action, X the president. I care less about that, just in general. If you have fart coin as a staple within your portfolio, God bless you. But but you're getting towards that end, or close to the behaviors of that end. What's nice right now is that we have not seen any of that behavior trickle into credit markets yet, right? Into massive amounts of consumer losses as far as major frauds or security vulnerabilities, right? So let's say like somebody was able to find out a way to completely just pull money off the blockchain for Bitcoin, right? And just boom, next thing you know, $500 billion is gone from the crypto markets out of nowhere, or Satoshi or whatever, like rug pull. We haven't had that yet. To create that domino effect or catalyst. And markets really don't go down until you have an exogenous event, black swan event, or credit liquidity, dries up. And right now you don't have any of those things yet. But the behaviors of certain things, like meme coins, I think symbolizes that we are tiptoeing close to that end. I appreciate y'all. I will talk to you guys next week.
All right.
I look forward to watching this on YouTube. I always watch this on Fridays. Let me just say real quick, on Fridays after I get done, when I'm not usually on this show, right? But every Friday when I'm done with everything, I crack open a beer, and I swear to God, there's two things that I watch. Swear to God, I watch the Holy Macro Show when I can, when it's available. I watch it, and then I watch AJ Monty Sticky Trades. He's also good. He's a good follow on the technicals, and he's kind of like a down to earth guy. I don't agree with him politically on anything for the most part, but he's a solid cat. So these are really good for the Friday after work. Crack a beer, let your dog out, sit back, listen to what's going on, and get prepared for the weekend, because this kind of throws out some good trading ideas. So thank you guys for putting this one together, and I'll see you all next week.
All right, thanks for dropping in, Kevin. Much appreciated, man.
Thanks,
Have a good day.
Thanks, Kevin.
So yeah, we can hop on to what's next, unless you have something you want to add, just because it's fascinating to just kind of talk it through, because I think one, it's almost like a moral conundrum. Do I care if people can get in and out of trades? And the answer is I can't be in charge of everybody else's life and everybody's portfolios. As much as I would love to help, like that's the goal of my product: teach people how to trade, show them what a professional trader does, how to make money, how to do this on a high level. That's all my product really is, if I really boil it down. But at the same time, it's like, I know I could, and it's what you and I have talked about a million times. I could take my strategies and I could put them all on a billboard. I could send everybody the codes for everything. I could say, just run it. It'll be great. And, the second it starts to go sideways for a week or two, they're not going to believe in it because they don't trust it and they don't understand it. So it's a hard thing, because it's like, yeah, like what do I need to do as a trader is what I try to think. As a trader, I need to ride the trends. I need to be able to get in and out of positions. As a person, I could see it a bunch of different ways. As a person, I would go, there is a situation here. There is something building here. It doesn't matter to me. Does it make me get out of any trades that I'm in currently? No. Does it make me look at the market any differently? No. And it's always goes back to that same thing. Like I was thinking the other day, and I posted this, and it just blew my mind that this was real. And I think the chart's actually right here. It was on TrendSpider too. So let me see if I can bring this up. So weekly, and I think I had one. Anyways, the point is, I'm not going to put all my signals out for everybody, but I put it on my channel. And basically, we got long the NASDAQ here, and we haven't had a full sell signal in the long-term portfolio this whole time. And that just blew my mind the other day, because this thing's been in an uptrend for that long at the moment, where we're going back to January 2023, which could have been, basically year-end 22 into 23. They're talking about 1 full year, 2 full years, and now we're starting this year. It's still in an uptrend. And most of the time, it's when you study trends, especially in equities, it's very rare to have one without a sell signal for this long. So, once again, does that tell me that something's coming? I can't control that or understand that. I know that I've been in this trade for a while. I know that I think there's much better places to be. But I also, as a trader, I always know I don't know where my biggest winners will come from. If you'd have told me, I'd be holding technology from January 30th, 2023 till today, I would have told you you're freaking crazy. Like, I'd have been like, there's no way, especially at that point. For me, I thought it was a false signal, because if you look at it, literally it got the signal, and then that the banking crisis happened in 2023, and it literally got very close to getting stopped out, and then it just continued to rally, and it just never turned back. So it's kind of an interesting thing to think about. One is, I don't know how long a trend in technology will go. But also, and you've mentioned this before when you were talking about NVIDIA, I don't know how far a bubble can go or how far fraud can take something. But we do know that it will end at some point, most likely. Does it end in devastating fashion? Does it end in a 50% drawdown? I don't know. I don't know what the reaction from the Fed will be anymore. I mean, I would have thought COVID shutting down the entire economy should have been a great financial crisis type of catastrophe, especially because, as we talked about last week, we were already heading into a recession. So if we're already heading into a recession, we have all of these things together, then we shut down the economy, and then the market V bottoms. So it's the reason why as time moves on, I look more at liquidity. Fundamental wise, I'm looking at liquidity and the rate of change. That tells me more than what's really happening anymore, because it's the reactions from market participants that keep the bubble flowing. Now that doesn't mean, like, once again, I don't know if this is a bubble exactly. It has the hallmarks of it. If you look at, what we talked about last week, all the meme coins, all this other stuff going on, there's something going on here. It's very reminiscent of 2021. So at the very
So
least, go ahead, Kishab.
yeah. So the meme coins, the bigger picture, the meme coins are just a sentiment indicator. It's not really a big deal. So look at how much the Max 7 is moving in a day. Something like 30 to 100 billion pop,
Mm-hmm.
and the entire meme coin market is what, less than 5 billion.
Mm-hmm.
That's it. So it's a small market. It doesn't really matter as such for the overall broad market or the economy, except for the fact that meme coins are doing this, and because I have studied history and I have lived the crypto cycles for a long time, it reminds me a lot of 2022. So everyone looks at November 2021 and says that was the top for crypto. And it actually wasn't. That was the top for Bitcoin. Bitcoin top first, and then came Ethereum. And after that is when the NFT mania started taking off. So that was when you had DeFi, which is yield farming. So people were getting crazy yields just rotating their stable coins from one decentralized platform to the other. And then you had this whole crazy boom with NFTs where uh, people, Board Ape, Yacht Club, all these guys started minting NFTs and selling them. And then you had guys like Raoul Paul saying he changed his Twitter profile picture to a monkey. I'm not sure if you remember that. And he's like, NFTs are the future. And so you had that whole craziness that peaked somewhere around Feb 2022. And that was when the FTX Super Bowl ad was ad. And that was truly crazy. So you had all these big celebrities like Tom Brady endorsing FTX, and that was actually the top. And it was a top in the sense that it didn't really matter that it was a top, except for what happened next, which is you got a credit deleveraging event in the crypto space. So because of good times, all these funds had built up quite a lot of leverage. And when the DEX platforms broke, so you had the Terra Luna ecosystem collapse, and that killed all the yield farming. And because all these guys had used Bitcoin as collateral, Bitcoin went down like 40%, even though Bitcoin had nothing to do with that entire credit bubble, because Bitcoin was completely out of the DEX, the ecosystem. Bitcoin went down 40% simply because it was used as collateral. And in a crisis situation, the best collateral is the one that gets liquidated. So you had those kind of events happening then, and that was why all these meme coins and speculations mattered. And coming back to markets, if you look at interactive brokers, so they announced their results, I think, start of this week, and they said that they had never seen so much in margin loans ever in the entire history. So margin loans hit a record high. Now you have a situation like this, and if you understand what happened in 2022, you can just draw the parallels and see when something breaks, is going to break big. Now you trade the futures and you trade the broad indices and not the individual stocks, and you have plenty of liquidity to get in and out. Plus, of course, you are always in the market. But when I talk to family officers and HNIs here, we talk about individual stocks. We talk about long-term trends, because these are not guys who want to be in the market trading every day. In fact, I get asked, why do I trade? Because my ideas are kind of more long-term. So these are not guys who want to trade every day. And so when I talk to them, these are the parallels that I want to draw. Because, like you said, if it's a retirement account, if it's a day trader, it's a swing trader, your approach would be completely different. So, if I say, yeah, okay, you can stick with tech for now, but you sell it in a month when things break, they would rather just sell it now and say what next to rotate into. Because
No, that's a good point. That's a good point because that's why I wanted to say let's talk about time frames a bit because it matters in this situation. For me as a trader, for you as a trader, does it matter that much? No. But if we're looking at something, even someone who's, waiting long term, like even like something like, Kevin's talking about earlier, there's different areas to be in the market if you are a person who's like, hey, tech has ran a pretty long way. I even like the idea of going, more all world than going just United States at the moment. I think there's a lot of big possibilities right now building. I don't know if I think tech will crash or if the US will crash in any way, but I do think there's a possibility of underperformance for a very long time. We've had this massive outperformance. People think it's going to last forever. And once again, that's how markets go. That's why people like us can make money because when people are all on one side of the boat going, this is going to last forever, we can kind of find different areas that we want to be in the market. I like looking at other areas, like even emerging markets right now. There's some areas in emerging markets that look really good. I was telling people the other day like how lonely it is to be a macro trader, like, and just talking about macro things like, hey, I'm going to buy Chile today. Hey, I'm going to buy, and like, we're looking at Poland and Chile and these things. And it's like, there is a lot of things happening out there right now that nobody's paying attention to. Chile is a huge one that could be a massive move, but you will not hear anybody else really talk about it because especially in the United States, it's not globally. Globally, you talk to people, they trade all the forex currencies, they trade all the pairs, they understand them very well. But if you're in the United States and you're like, do you trade forex? Most people will say no. They have no idea how to trade the currencies at all. Maybe they've traded the ETFs once or twice. Found out that they don't really make you much money because you can't get any leverage in ETFs, and then they never trade them again. So that's the big disconnect that's going on right now between America and the rest of the world is why I kind of think there is a huge opportunity here. Does it like, and most people are going to come back to this in a year and be like, well, I was in SPY and I made, 10%. It was fine. We didn't see this crash. And it's like, it's not about a crash. It's about if you can be in an area where there is outperformance, that is what you want to do. If you're trading and you're trading in line with the S&P 500, you might as well just shove your money in the S&P 500 and walk away and go enjoy your life and never even think about it. But if you want to trade at a high level, you want to look at these different areas as a trader. Because for me, it's not as a trader, there you still have a point. And the point being, there's a lot of things like the real economy. You could talk about those type of trades, energy, materials, industrials, and so on. You could talk about these other countries that look amazing that we could be buying right now that nobody's even going to talk about. There's so many things kind of happening. I was telling somebody the other day, I was like, yeah, I'm shorting bonds. We're like, wow, I've never even thought to short bonds. That's very interesting. It's like you can do all of these things in trading and nobody is doing it. It's mind blowing to me.
Yeah, and the problem with the world market is I think somewhere around 73% of some of the all country world index is just the United States. So then you
That's
have
I'm
to
not saying I'm not saying just buy the thing. Like if I was a person doing something long term, or if let's say you're a normal person, that's a possibility. But I would rather do the approach of if you're going to do it as a long term trade, something like you and I would do would be you would go even further in depth and find the actual stocks. I would go more, okay, I'm going to reweight the portfolio, maybe 10%, 15% the United States, maybe, different countries inside of there. Stay away from those big ETF indexes, maybe look for specific countries, stocks in those individual countries that you like. There's a bunch of great things you could do for a retirement account, but I doubt people are gonna do it.
Yeah, I mean, US outperformance is something that's been so taken for granted that can't imagine a different future, and especially with tech. So if you go back to the after the dot com burst, the leader in that entire decade was financials. It wasn't tech at all, even though tech actually continued to grow earnings. So you had Google, Netflix, all these great companies coming up in that era, but everyone was so enamored of financials. And why? Because the yields were amazing. And that was the time when US got this big uh, boost in terms of uh, the trade deficit with China, which meant all the capital got rotated back into the US economy. So the US got financialized, and that was the time when the banks did really well. And now we have a time when tech does really well. And maybe going 1 or 2 years out, it's going to be energy, it's going to be mining, because Trump, the way he's talking, it looks like he really wants America to boom again as an industrial economy, which means you bring back mining, you bring back manufacturing, you bring back energy. So I think the 5 years from now, if you look back, it will be so obvious that you should be in energy, you should be in mining and not in tech. But right now, that conversation is just not happening. And that's mainly because the news cycle is such that everyone's talking about the AI boom. So in any other market, I'm sure if someone had come out and said, so when SoftBank came out and said they're going to launch their $100 billion vision fund, it was met with skepticism. No one believed they could raise 100 billion. And now you have a guy coming out and saying he's raising 500 billion, and Elon Musk is fact checking him on Twitter, and still nothing. The market doesn't care. So this is all just a part of the shift. And once it shifts, then it will become obvious that this was the point where it shifted. It's just like when you look at, I was talking about crypto earlier. So you look at NFTs, you look at DeFi and yield farming, that marked the top. And the only way you would know that is in hindsight. But with foresight, it just tells you, okay, maybe this thing is 2 months away from blowing up. Maybe the rotation trade, the catalyst, whatever you want to call it, happens in a far off future. Not exactly a far off future, but like maybe 60 days from now, 90 days from now. Do you really want to be in this trade, which is getting extremely crowded, which is getting silly, which is getting close to an exit point? Or do you want to say go where no one is looking right now? So, for instance, 2014, everyone was buying Chinese equities because the big news back then was Morgan Stanley was going to add China to their MSCI index, and that was going to bring in a lot of passive buying. And then you had all these tech IPOs, follow on IPOs, and the big wave of Chinese companies listing on the NASDAQ, and everyone was chasing China. 10 years later, where is China? No one cares. We are probably at the beginning of a bull market in Chinese tech, and no one cares. And that's because everyone is just focused on the AI narrative, the US tech narrative. So if you just zoom out and forget about the rest of this trade, you can find so many opportunities in places where no one is looking, which means you can buy it and just forget about it because you don't have to trade it. You're getting in it in a great entry point, beginning of a trend. It's like how you spoke about when you got into the NASDAQ trade on Jan 2023. You pretty much didn't have to do anything for the next 2 years when you got that entry point. And I think that's the kind of entry point that's available on so many different themes, so many sectors and countries right now. And I think that's the message that I really want to tell today, because it's not just about me not liking the AI bubble or all the financial and accounting fraud that's going on. It's something bigger, which when you zoom out, it's like here you have something like a generational lottery. So once in a decade opportunity to take a longer view and just compound while doing absolutely nothing. Just buy, and you're going to have minimal drawdowns. And that's the thing, because none of these markets have any volatility left because no one's even trading them. So what is your downside? It's very minimal. Just get in and you can forget about it.
I mean, this was a good point that was brought up. And, you and I, we talk about sector rotation a lot. And if you think about, the strategy that has worked for me all these years is sector rotation. And, if you take a look at our portfolios this week, one, we've had a ridiculous month so far. But if you look at the portfolios this week, you're seeing how much the signals are moving into the reflation trade at the moment, like across the board. Like, so what we're talking about isn't only speculation, it's just happening. It's just real. So, there's two different sides of it where you could look at it and go, okay, well, this trade has legs or this trade is long in the tooth or whatever. But all I can say is that the signals are continuing to point to these areas. If you look at oil starting to pick up, if you look at energy starting to pick up, you look at copper starting to pick up, you look at all these things starting to pick up, you're really starting to see a movement that's different and has a different look than the last 2 years. And really, it started back in 2020. And you and I know this. Commodity super cycles are a real thing, and they don't just start and stop. Usually, you see, just like, and this is the same formula you and I have talked about forever. You have the Fed, and they usually get behind the curve. As the Fed gets behind the curve and they start to go, hey, we're going to stop raising rates because we have killed inflation, they start patting themselves on the back. You and I talked about that ridiculous thing from Powell, basically just celebrating himself for killing inflation. Great, awesome. It's hilarious to you and I, but once again, it's just kind of another signal. Then they start to lower rates. As they're lowering rates, the long end of the curve's laughing at them and it's moving the complete other direction, which is killing bond prices. And then bond yields are just moving higher. So, and then you and I go, okay, so back to the playbook. We're in a commodity super cycle. I'll bring up the chart of energy because it really kind of says it. And if you guys have seen the chart of commodity versus um, bonds and commodities versus equities that I always post, those really tell the story even better than this. But if we're looking at energy, this is the beginning of it here. We're kind of seeing it bottoming out. After COVID, there was some deflation that stuck around, disinflation, so to speak. They dump all the money. We get all the helicopter money as it starts to find its way into the market. Energy becomes the best performing sector under that 2-year time frame. It's actually the best performing spider sector under Biden, actually. So for 4 straight years, it is the outperforming sector. It doesn't look that pretty lately, but it did very well. So it basically, we move up in this big trend, and then it starts to top out right about the time they start to raise rates, and they're raising rates, and now energy is topping out. It's moving completely sideways. Then we see a new break to the upside. This is where this is going to start. So we'll probably see a new break to the upside here. And this always lends to other areas like Kashop and I are talking about today that we're going to want to be involved in as we're trading these markets, like materials, like industrials, like energy, like the real economy stuff, the stuff that isn't going anywhere, the stuff that isn't that sexy, and the other countries that nobody wants to talk about. Like, these are the things we're going to see. I had to go in a second, but I wanted to touch on somebody said something, so I wanted to touch on that real fast. You got a sec, Kashop?
Yeah, sure.
So I just wanted to add this. I've been trading by myself and losing all the time. And so I wanted to just talk about this for a second because this is important, and I'm glad that was brought up because I think that happens to everybody when they first start trading. It's a you start trade and it's, if you want to admit it, there's people out there that don't admit it. They start trading and they're telling everybody how great they are at trading, and really the truth is everybody starts trading and they lose money. I've been trading for a long time. When I first started trading, I lost everything a couple times. That's how it goes. And so that's normal. There's not one professional trader I know who doesn't have a story of blowing up or losing a ridiculous amount of money or something like that. So I think one thing, I just want to say is, one, find a group of people that you're comfortable with sharing your strategies with. You know, people that you could go, hey, I messed this up today. Hey, I did this wrong. Find somebody that shows you how they're trading so you can emulate their trading. That's also important. And I think a thing that a lot of people don't think about, because you want to just find things that are fun to click on. Kashop and I are both people that you can see our portfolios. If you're our subscribers, you see our portfolios, you see what we're doing. Those things are really important. If you can't see what somebody's doing, and they're not really trading, then that's not something. Like, you want to see the positions, you want to see if they're long, short, and most of all, you want to understand their discipline. Like, do they have a disciplined approach? Do they continue with that same approach over time? Do they change their approach constantly? People who change their approach constantly, they're the people who lose money. It's the reason why Kashop and I could trade totally different ways and both make money. So it doesn't matter like what your strategy, what your style exactly is. It matters that you have the discipline to stick to it, do it well, use it during bad times, good times, and understand that you back tested this and look backwards and understand that it makes money going forwards. But I think most importantly, what I'm saying here is try to find a community of people. I don't care who it is, traders that are learning how to trade, that you can talk to, that you can share ideas with, and be very open. I think the best thing I ever did when I started trading was just having an open portfolio with a friend, sending, hey, here's my positions, here's my trades, here's my returns, this is what I'm doing wrong, this is what I'm doing right. And the more I was doing that, the better off, like, you feel open about it. You don't want to, like, and especially trading professionally. When I started trading professionally, now it's like everybody sees everything I do. And so now when everybody sees everything you do as a professional trader, you have to really be disciplined in your approach. You have to not just hang on to positions that should be out of because you're running a system. You have to do things at a very different level. So I say, be very open with your portfolio. Be very open about losing money. Don't be afraid to say I lost money. You have to be comfortable with that. Trading is a game of losing, just because of the way the probabilities work out. You have to be comfortable with losing, so you can maximize your returns, meaning take small losses, not big losses. Big losses are bad and catastrophic. Don't do that. Small losses where you can take a small loss so you can take the next trade, that's important. So that's mainly what I wanted to say. I wanted to bring that up because, I've been there. I think every trader's been there. And so I'm glad you said something. Please come back. Kashop, do you have anything to answer or to add to that?
Yeah. So I'll just add a couple of things there. And I totally feel you because I have been in that exact same situation. I started out as an analyst and I didn't know what the hell I was doing when I started to actually trade a portfolio. And my first article on my newsletter talks about all my blowups. So what changed for me was reading Alexander Elder's Trading for a Living. When I read that, I confronted the fact that I really was powerless over my trading addiction, which was what it was then, because I was just doing random things because I thought I was smarter than the market. And I was smarter than the market as an analyst, which was why I made good money as an analyst. But when I got the thinking over to trading, it did not work at all. So the first thing reading that book taught me is the market always knows best. You have to be humble. And the second thing that I did to change my habits was read all of Van K. Tharp's books. So it's all about psychology, it's all about risk management. It's nothing to do with how do you pick stocks, how do you make 100 baggers, none of that. It's all about how do you work on yourself so that you become a better trader. So once I put all of this together is when the mistakes reduced. And that is the point at which I started making money because everyone can actually pick good stocks. It's not that hard. What is difficult is being disciplined, managing your risk, position sizing, not getting emotional over or hung up on one or two trades, and all the other psychological factors that go into it. So, if you're a losing trader, I think it's important to work on the psychology first and then maybe listen to other traders. So, go to top traders, unplug, go download all the podcasts, listen to them. They may have different styles, but that will teach you something. And read books like Trading for a Living and Van Thorpe's. I forgot the names of his books. He has like a dozen or so, all on psychology. And I think if you work on that, then maybe a couple of years you can become consistently profitable. And it does take that long, because it's not like you can just go get an MD and do a heart surgery the next day. It doesn't work like that. And it's the same with trading. In fact, it's probably more difficult because this is not about skill or technical proficiency per se, as it is about emotional and all the other aspects that go into it. So hang in there, and I think a couple of years, if you're really serious, you can become an amazing trader.
Yes, absolutely. And the one thing I wanted to add before we go, have you read is it The House of Money, the one with all
Inside
the
the House of
interviews
Money.
and
Yeah, yeah,
with Jim Leitner, right?
yeah.
I just went over that interview again, and man, there was a really good point in there where he talked about, I'm always ignorant. It's called Inside the House of Money. Is it a Sebastian Mallaby book?
It's Stephen Drobny.
Stephen Drobny. Okay, Stephen Drobny. So Stephen Drobny, Inside the House of Money. But so Jim Leitner's section in there, it's one of my favorites. Jim Leitner is one of my biggest inspirations for the way I trade. So reading that again, and he had a conversation in there, or a question in there, where he's talking about, what is it? Averages, being average, not being really, really good, not being super early, and talking about how, like, he knows tons of smart people who are much smarter than him in trading and know more about markets, who are wrong all the time because they're almost too smart. And what he did is figure out and back test this, and found out if you're too early in strategies, like whatever the strategy is, you don't make as much money as the person who's just on their average time frame. So if you're just average at trading, you can actually make a lot of money. And he also shows like being late actually makes more money than the people who are so smart and are really, really early. And so I'm probably saying, I'm paraphrasing this, so I'm not saying it as deep as he said it, but I wanted to mention that to you to check out, and everybody on here to check out that book in that section, because it's really spot on for why trading any type of trend strategy really works. Any type of idea that's like, okay, we're finding some momentum behind the move. Why does that work? And he kind of goes through that in a macro sense, which I think is very cool. Now, once again, this isn't for stock pickers. This is a macro, finding big trades in either commodities, indices, world countries, and so on. Or currencies. So check it out. All right, guys. Thank you guys for joining us today. It's the Holy Macro Show. We're on every week on Fridays, around 11. We've been 11:20 lately. So we'll see you guys soon.
Bye, everyone.